In this question, you are being asked to calculate the depreciation charge for the year ended 31st December 20x5. You've been presented with a T account for the plant and machinery at cost ledger. The information contained in this T account will be very useful in helping us to work out the depreciation. Particularly important in this question will be the dates. We have a final sentence that reveals the company's depreciation policy, which is 20% straight line, and that's proportionate depreciation in the years of purchase and disposal. I think the best way to deal with this type of question is to firstly visualize a timeline. So let's do precisely that. We're told that the year end is December, so the beginning of the year will be January, with the end of the year being December. The information in the T account reveals that on 31st of March, there was a disposal of an asset. So if I mark that up in my timeline, 31st of March, they have a disposal. Because the depreciation policy is proportionate in the years of purchase and disposal, we can establish that for at least 3 months of this year, the asset that is disposed of would have been depreciated. Thereafter, they've sold it on, so no depreciation is relevant for the later 9 months of the year. We can also see that on the 30th of June, they made a purchase of an asset, and that would be an addition to the business. So if I mark up 30th of June on my timeline and label it up as an addition, what I can clearly see from my timeline is that based on this policy of prorating for the years of purchase and disposal, that only 6 months worth of depreciation would be charged for this asset, and that is from the period June onwards when they've acquired this asset. For the remainder of the assets in the business, a full year's depreciation would be charged. Armed with this information from our timeline, let's produce a working to help us calculate the charge for the year. I'm going to start off by thinking about the additions for the year. We can see from the timeline that the additions made have a value of 160,000. With a depreciation policy of 20% and a timeline revealing that only 6 months worth of depreciation should be charged, we can identify that 160,000 multiplied by 20% multiplied by 6 months of the year gives us 16,000 for the additions. Next, we can deal with disposals. Looking at the T account, we can identify that for disposals, the cost of the assets disposed of was 60,000. Again, the policy of 20% applies, but this time we're charging only 3 months of depreciation on the assets disposed of. So taking 60,000 multiplied by 20% prorated for 3 months of the year gives us 3,000. Lastly, we can deal with the assets remaining. Now, be very careful here, because with the assets remaining, yes, we've got 240,000 as the opening balance, but included within that number would have been the assets of 60,000 that have been disposed of. We do not want to depreciate them again. Remember, they were disposed of partway through the year. So what we need to do with the depreciation on the assets remaining is to take 240,000, remove the 60,000 assets disposed, and multiply that by 20% because depreciation needs to be charged for the full year. There is no prorating required. Multiply this out, we get 36,000, and if we cast down, we have a total depreciation of 55,000 that should be charged to the statement of profit or loss. In this particular question, the option that reveals that is option B, or the second option.